exactly what Rick Rieder lives and breathes. He's BlackRock's global allocation team head. He also has a side job as the global fixed income chief, too. You're busy, man. I got to tell you.
Every day.
What was your first reaction when you saw the CPI number?
It's pretty good. I mean, listen, have we solved inflation? No, we haven't solved inflation. We're closer to target. It's also, that number was a little funky today because we didn't get October. So it was a little messy. You got to cut through that and say, okay, what does it mean we don't have October? So you're coming off a number that's not clear. But the truth is, I mean, it's good. Inflation is, you are seeing some moderation. If you take the last 3 months, 6 month moving average, core PCE, core CPI, we're in the high twos, not at target yet. Listen, I actually don't think inflation is going to be the problem in the future. I think, as you were describing earlier, I think we have a labor problem in the country, and a significant labor problem.
Okay, so you think the significant labor problem right now, we've got inflation at 4.4%. How significant is that? I mean, historically, it's still rather low.
The unemployment rate.
Correct.
Yeah, so when you actually break down, so 4.4 is not a disastrous number, but it is trending up. It was 4.1 a couple of months ago. It is trending up. If you get underneath the surface and you look at what I think is a real problem, if you take youth unemployment, people 20 to 24 years old, it's 8.3%. Millennials are having a super hard time today. If you take lower skilled jobs, you take the U6 is 8.7 unemployment. We have an incredible bifurcation in the economy today. Young people are having a really hard time. You saw in the Michigan survey, it's the hardest time getting a job since they've been doing the survey. It's very, very challenged. What we have, low income, young people, small business are really struggling. And I think that is the problem. And I think that unemployment rate is going to keep trending up, but particularly making it difficult for that cohort.
So when you look at some of this data, it could very well be distorted due to the government shutdown. But does anything about it say to you that it's legitimate to spur portfolio changes?
So listen, does it spur dramatic portfolio changes? I think the one thing that we do and I think is important, I think interest rates will come down over the next year. I think and I think what's really important for the Fed is, can you get the 10-year note down to 3.5 to 4, keep it constant? If you keep that to 3 and get that to 3.5 to 4, gets the mortgage rate down. So what do you do with that within portfolios? I like agency mortgages quite a bit. I like taking, we've talked about on this show, I like owning interest rates in the sort of the middle part of the yield curve, the 5-year part. They had a great year. I mean, think about this year. I mean, fixed income and a bunch of our portfolios are going to throw off 8.5% return. Pretty good for fixed income.
Fixed income looks good. The short end of the yield curve, the T-bills, those a year ago, we sat here and looked at them at 4 or 5%.
Yeah.
Is that ship sailed?
I think it's on its way. I think that those cash levels are going to come down. I think there was one thing today that was fascinating. There is, so we got through the employment report, we got through the CPI report, and what then it shows you is there's so much, why are tech stocks rallying? People don't want to take risk until they see these big data points come. I actually think even if the number wasn't as favorable, markets would rally. There is a ton of money sitting in cash. There's $8 trillion sitting in money market funds. What happens is as long as you get benign economic data, and as long as you have a Fed that is receptive to moving that rate down, equity markets will continue to do well.
They go directly into the very area that's already had a huge run up. You're talking about risky assets like maybe the AI names or AI adjacent. And I mean, right around now, the fear is starting to creep in there. So let me just get you on rates.
Yeah.
The market is only pricing in 2 rate cuts in 2026.
Yeah.
Are you with that?
I'm with it that by the way, I would do it sooner. I think you can get those 2 rate cuts done. Yes, I think markets are not pricing January after the Fed just went.
26%
I think there's
odds. That's not very much.
No, I like those odds.
Okay,
I actually think when you take the labor report, you take what is benign inflation, I think the Fed should get the equilibrium funds rate should be closer to 3. If you take 5-year inflation break-evens, expectations on inflation, it's 2.28%. If you get the funds rate to 3, you're still well above the expected rate of inflation. So I think you have to get there. I think they'll do 2 cuts.
Okay.
I think they'll do more than that, and I think you can do more than that.
I know you're not going to answer this, but I'm asking. I'm going for it. President said he really liked Chris Waller, but he also said there are 4 candidates.
Yeah.
We know Kevin Hassett, we know Kevin Warsh, now Chris Waller. Are you the 4th?
So can we go back to the CPI report? The CPI report No, you're right. I can't really answer, but anyway, I think the first time I got to talk about it was when I was on the show with you, and I said, which I'll say again, it's the biggest honor of my life to be in this consideration. Sure. But anyway, I got to focus on if the S&P is going to be finish the day on the upside.
You don't see any recession signals at all, do you?
No, I don't. I think. So I'll break that down a little bit. No, I don't. I think the economy, first of all, we have fiscal tailwind. We have tax receipt dynamics that are at play. You've got AI, CapEx spend that's significant. However, you have an economy that's operating well on a couple of cylinders. You know, we talked about, it's actually an extraordinary thing, and nobody's ever seen this generation. What's driving consumption is people 55 and above, older savers. And it's incredible about how consumption is concentrated there. That group is doing well. We'll continue to keep consumption in a good spot. And then CapEx spend, AI. I think you need to have an economy that becomes broader in terms of, we're talking about small business.
Well,
we're talking
as
about,
you said, unemployment for the youth is 8+%.
Yeah.
That's
and by the way, it's going to go higher because of the dynamic that it is so difficult coming out of school today. You know, you have, AI, what companies are doing that's pretty extraordinary is they're holding on their existing labor. But what's going to happen over time, you see big companies announcing layoffs. Over time, they're just going to let attrition work its way through.
Fire.
Right. So I think that youth unemployment number is going higher, which I think is a travesty.
I know we have to wrap, but I have two questions. One, how do you fix youth unemployment? You said it's going to go higher. How do you get it down?
The big one, and I think to start with the president describing this dynamic, housing is such a big deal for a couple of reasons. If you get housing velocity moving, it increases labor mobility. Nobody can sell their house. You're a young person. You can't unlock the value of your house, and you talked about that. You get that. You put 3 people to work for every home built in this country. That really helps. That is the place you start. Listen, then I think there are things to do with student loans. I think there's things to do in a bunch of different areas. And listen, over time, I think, to me, the whole key, I said this, I'm involved in a lot of urban education, my school's in Newark. The key is education is the key. And because you don't really know how the transition is going to, but lower skill jobs are going away.
Austin Goolsbee, Chicago Fed president, coming up. What's your question for him?
So, my question is, can you balance inflation versus labor today and get to the place where I think the equilibrium rate is lower than where we sit today? Do you agree with that? Or do you think you just got to be a bit careful and deliberate on getting that rate lower?
Great to see you.
Thanks for having me on.
Happy holidays. So glad.